all these wild market swings and the coronavirus uncertainty, putting extra emphasis on the Fed's next monetary policy move. Yahoo Finance's Brian Cheung is at the Shadow Open Market Committee Spring 2020 meeting. It's happening in Midtown Manhattan, and he joins us now on the phone. So, Brian, what a week to have this meeting. You just heard Jared talking about the 42 basis point drop we've seen in yields on the 10-year, historic levels there. Also an emergency rate cut week. Is there a consensus there, I guess? I mean, what are people focusing on today? Is it coronavirus? Is it what the Fed's going to do next? Is it yields? Where are people focusing?
Hey, Jen. Well, yes, all eyes are certainly on the Fed. And this was a pre-scheduled event here in Manhattan where there are 6 Fed presidents. That's 6 of the 12 Fed presidents, so half of them currently president. They were supposed to be talking about a pretty high-level discussion on monetary policy, specifically with regards to the framework review that they're currently undergoing. But as you mentioned, a lot of the focus just on the short-termism of what will the Fed do regarding the coronavirus. You had St. Louis Fed President James Bullard saying, I think we'll have a slowdown for a while, but said he does think markets seem to be pricing in the very worst outcome here and saying he's not quite sure that's warranted. He also had Chicago Fed President Charles Evans saying that there's so much uncertainty. Have a listen at what he had to say today at the SOMC.
Describing uncertainty is very difficult, but at the moment, we're facing a new risk. Public health safety is paramount. That's really the first, second, and third response. And getting on top of the emerging spread of COVID-19 has to be the highest priority among everything that's taking place today. But of course, the Fed is going to be paying attention to how this is progressing and responding as appropriate.
And you can hear Charles Evans there saying the same boilerplate language that's been used by Jerome Powell after that emergency cut of 50 basis points earlier this week. You also had New York Fed President John Williams today saying heightened uncertainty will cause people to pull back on investments. That's for both businesses and households. So the same kind of talk from all the Fed presidents saying, look, we're watching and trying to see exactly how this is going to play out. But it's really difficult as monetary policymakers to see what's going on here. And that ultimately it's going to be on fiscal policy to try to address this concern.
Brian, this is Emily. Just looking at the Fed speakers overall this week, not just today, one of the ways that the Fed really steers financial decisions is with their forward-looking guidance and the communications that they give. So just looking at what these Fed speakers have said, has it been clear and consistent? Does the market really know what the next move is going to be? Has that been enough to appease people in the market?
Well, I think the Federal Reserve has pretty much acknowledged the difficulty in trying to communicate something like this, especially when you have an exogenous shock that isn't anything that is easy to model. It's one thing to discuss the possibility of trying to hedge against, let's say, inflationary risks running out of hand, as was the case in 2018, the last time we were seeing 1,000-point changes in the Dow. But you did have Loretta Mester from the Cleveland Fed acknowledging that the statement maybe isn't enough right now. She was actually advocating here at this meeting in Midtown that they should expand the statement, saying that if they were to have more words in the statement, it would give the less credence and less power to each individual of the words that are in the statement. So that's just one idea here. But again, you have a lot of Fed policymakers facing this existential crisis about what can you do structurally to try to better communicate what is inherently a difficult thing to communicate? And I think that's one thing that you have a lot of Fed speakers talking about, especially as they have this framework review, which is supposed to wrap up the middle of this year.
Well, and speaking of talking about what you can and can't do, Eric Rosengren, I don't know, Brian, I don't know if this was your read on it, but I think a lot of people in the market saw his comments, which he made at this conference not too long ago. And it sort of implied that the Fed's next QE program would have a wider scope in terms of asset purchases if it came to that. And certainly you look at Fed funds pricing and there's a view that it will come to that in the not so distant future. What was your read on those comments? And do you think he is basically trying to lay the groundwork for the Fed starting to look a lot more like the BOJ? And we would remind viewers the BOJ, among other things, purchases ETFs as part of their long-term asset purchases.
Well, as you mentioned, it was a pretty incredible speech from Boston Fed President Eric Rosengren. His suggestion was that quantitative easing may have little room to lower long-term yields because longer-term yields are already super low and appear to be headed towards zero when you consider that the Treasury yield was a tick below 0.66% as of this morning. So if the whole point of QE, especially when they were doing it after the crisis, was to lower long-term yields to make borrowing cheaper and encourage people to actually get involved with spending out there, then maybe the Fed doesn't need to do anything right now because bond yields are already so low. So the question is, if the Fed needed to do quantitative easing, what could you do that would be more potent if bond yields are already low? his suggestion is to expand the amount of securities, the type of assets that you can buy. He didn't specifically say what, but as you mentioned, Miles, when you look towards the BOJ, which is buying equities, when you look at the ECB, which is currently buying corporate bonds, those are both things that the Federal Reserve cannot do right now because the statute doesn't allow them to. When you look at Section 14 of the Federal Reserve Act, it tells you that the Federal Reserve cannot buy anything that is not guaranteed or at least issued by the government, which is why it was limited to mortgage-backed securities that were partially guaranteed by Fannie Mae or Freddie Mac during the crisis. So the problem here is that his suggestion to expand what the Fed can buy is only something that you can do if you were to change the Federal Reserve Act. So I think the actual point that he was trying to make was that this is a statutorily impossible thing to do. So it's on the fiscal policymakers who would have had to make that change to try fiscal stimulus of their own instead. And I think that that's maybe the proper read on this, but you do have a lot of debate going on right now about quantitative easing because that does appear to be the next big tool that the Federal Reserve would use in the next crisis, how they would actually implement that. And Miles, I want to mention one thing. Crossing right now is actually Esther George, the head of the Kansas City Fed. She's actually taking issue with what Eric Rosengren was saying. She said more generally, quote, I'm reading this, to the extent that large-scale asset purchases succeeded in their aim of creating a wealth effect, they also played some role in contributing to elevated asset valuations, end quote. So there's a debate going on right now about whether or not quantitative easing is or is not an effective thing when we're getting to a point where, Miles, it might be very soon that we'll be seeing a type of program like this.
Right, just reading some of these George prepared remarks there, it remains less than clear to me that the longer run costs of balance sheet policies have been fully taken into account. Brian, I want you just to put on your color commentary hat for just a moment.
There we go.
All right, no more like this is the part of the Fed,
Yeah.
like God, we're going to get out of the weeds. Just,
Quantify this.
Yes. Are people there calm, just like this too shall pass, we've been through this kind of action before, or are people nervous?
Well, here at the event, it's mostly academics. It is a lot of people who are kind of closely watching the central banking world and have been involved with the nitty-gritty and kind of the language of it for some time. But you do have a lot of people taking advantage of the question and answer portions of the program today to really press these policymakers on what are they going to do next. And I think there's not necessarily a sense of fear or a sense of nervousness here, but you do have this existential crisis is the way I would describe it, because the framework review, which, by the way, was something that the Federal Reserve had launched well before any of the coronavirus issues really emerged, is mostly focused on kind of what might be considered mundane topics, like how do you target inflation? Everyone knows that the Federal Reserve has a 2% inflation target, but how do you get there? Instead, what's happened as of the last, let's say, 2 weeks is that the whole framework review crisis question has been expanded to what are we even going to do if we have to do QE again? Should we be doing, and another thing I didn't even touch on was something called Regulation A, which is an authority that the Federal Reserve has currently to actually provide lending facilities to businesses. That's something that, they can only do under an emergency situation. And this is also a very contentious thing about whether or not the Fed's role as a lender of last resort is problematic or can lend itself to some types of moral hazard. But that's suddenly become part of the discussion here at this conference as well. So I think what we're realizing is that the Fed is really trying to open up all the tools in its toolbox, including the ones that have been, let's say, not used or have a lot of dust or we don't even know if they still work. And those are all things that are coming into focus as the discussion continues to unwind. And look, when you look at financial markets today and for the past few days, I think that's going to be a discussion that can only heat up in the next few days. Although worth noting, next week is a Fed blackout week, so this is basically it.
Get it all in.
Get the WD-40 out for the Fed. We're dusting off. We're dusting off tools.
Yeah.
You're going to need a little bit more than that, some elbow grease. Yeah.
Go back to the toolkit. Find out what you got. Brian Cheung, fantastic work. Have a great weekend.
Thanks, guys.
Hey, investors. Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.